Hey there, folks, it's me Sundar, and welcome back to Mindfulfinance, your friendly buddy for all things money. Today, we are diving deep into the world of investing. Hold on tight because we are talking about something that can truly shape your financial future, which is mutual fund. But don't worry, I'm not going to get into the more technical in this video. We'll break down the types of mutual funds, talk about the common mistakes even experienced investors make, and most importantly, I'll share a super smart trick that is called step up SIP to help you beat the inflation. Whether you are a pro or just starting out your money journey, there's something in this for everyone. Stick around till the end because you won't want to miss any of this helpful info. Alright, let's get this show on the road. Now, without further ado, let's jump into this amazing world of mutual funds. Alrighty, let's talk about the different kinds of mutual funds. But don't worry, I'm gonna keep it very simple, like chatting with a friend at your favorite chai spot. First up, we got equity mutual funds. These are like the spicy masala of the investment world, full of excitement. They invest in stocks which can go up and down like a seesaw, but they also have the potential for big returns. The next is debt mutual funds. These are like the comforting chai on a rainy day. They invest in bonds which are more stable than stocks, but don't expect them to make millionaire overnight. It's like you just need a mindful way of doing things. Let's stir things up with hybrid mutual funds. These are like a mix of your favorite flavors, a bit of equity stocks and a bit of debt, which are bonds. They aim for a balanced taste of risk and reward. Then there is index funds. These follow a stock market index like a GPS for your investments. They are simple, low cost, and try to match the market performance. I have discussed this index funds in depth, and you can go and watch that video. I'll provide the link over here and you can explore that. Last but not least, exchange traded funds or ETFs. Think of this as mutual funds that you can buy and sell like shares. They are like the on the go snack of the investment world. So there you have. Those are the things, the main flavors of mutual funds. Remember, each has its own unique taste, so pick the one that suits for your financial appetite. Now let's chat about the common goof-ups folks make when it comes to mutual funds. Picture this as your buddy Sundar giving you tips over a cup of chai. The first pitfall, lack of planning. It's like heading out on a road trip without a map or GPS. You need a clear goal like buying a new phone or a dream vacation. Next, lack of diversification. Imagine putting all your money on one card in a game of Thinpatti. In Tamil we call mosquito. Risky, right? You gotta spread your investments like having multiple cards up your sleeve. Now, short-term thinking. It's like planting a tree today and expecting a whole orchard tomorrow. Mutual funds are like trees. They need time to grow. So be patient and be mindful. And lastly, emotional investing. I had explained about emotional investing, which is loss aversion, in my previous video. You can click this link and check this back if you want. Think of it like riding a roller coaster of emotions. Fear and greed can lead to bad decisions. Stay cool and stick to your plan. Here's a story. Imagine your friends sold their mutual funds during a market dip due to fear. So most of the people does that. Later the market bounced back, but they missed out on gains. FOMO. Remember, my friends, these pitfalls are like potholes on your financial journey. Avoid them and follow a smoother path to your wealth. Alright, now let's dig into something really cool. Yes, the step up SIP. Imagine it's like upgrading your chai from regular to masala with a bit of extra kick. So what is this step up SIP? Well, it's like increasing your savings every now and then. You start small and then every year you put in a little extra money, just like you would add a bit of more masala to your chai. Now, why is this important? Especially in our Indian market? Well, it's because of our old friend inflation. Think of it as the price of things going up over time, like that's samosa that used to cost less but now cost more. Remember, we used to have tea for 2 rupees. Now same thing is sold for 20 rupees. I still remember I used to buy petrol for 16 rupees. Now it's 100 rupees. The reason is inflation. So let me break it down with a simple example. So you start a regular SIP of 5,000 bucks a month. Nice, right? Assuming a 12% return after 5 years, you would have around 10.5 lakhs. But with a step up SIP, you will start the same 5,000 bucks and increase it by 10% every year. In 5 years, you would have around 11.9 lakhs. That's more money in your pocket. Inflation is like a pesky mosquito trying to take away your purchasing power. But a step up SIP, it's like having a mosquito repellent. It helps your money grow faster and keep up with rising prices. So my friends, remember, a step up SIP is like your financial shield against inflation. It's like adding extra masala to your chai, making it spicier and more flavorful. I'll explain a live example to you to understand about this in detail. Alright, now let's talk about the ninja moves you need to choose the right mutual fund. Think of it like picking the perfect dish at your favorite restaurant. When you're choosing a mutual fund, there are few things to keep in mind. It's like checking the menu before you order your meal. First up, investment objective. Ask yourself, what's my money goal? Are you saving for a dream vacation, a new bike, or a retirement? Your goal will help you pick the right dish. I mean mutual fund. Next, risk tolerance. Think of this as choosing your spice level. Are you okay with a bit of heat, or do you prefer a mild flavor? Mutual fund comes in different spice levels too. Some are spicy, high risky, and some are like mild or low risk. Now, time horizon. How long can you wait before you dig into that tasty dish? Similarly, when do you need your money? The longer you can wait, the spicier mutual fund you can pick. And past performance. Just like checking reviews before ordering, you want to see how the mutual fund has performed in the past. It's not a guarantee, but it gives you an idea. And don't forget the fees. It's like looking at the price tag. Mutual funds may have charges. Some are like budget meals, others are gourmet. Choose what suits your budget. An investment strategy. That's like knowing what goes into a dish. Different funds have different recipes. I mean strategies. Some focus on stocks, others on bonds or both. Lastly, diversifications. Just like a balanced meal with veggies, proteins and carbs, you want a mix of mutual funds. Don't put all your money in one dish, I mean fund. So remember, choosing the right mutual fund is like crafting the perfect meal plan for your financial journey. Each factor is like a flavor you want to balance. Using food analogies and relatable examples can make the process of choosing the right mutual fund more easier, more accessible and enjoyable for your audience. I use these food analogies so that you can relate my examples and it would be easy for you to understand about the mutual funds. If you have any questions, drop a note. I'm happy to explain. So let's see an example. I tried to Google to find out which top mutual fund schemes. So in that I got the first result from ET Money, whatever it is, but these are the list of the top mutual funds being listed out here. I'm not going to really check whether this is the top fund or not, but just to demonstrate the step up SIP, I'm going to take an example of ICICI Prudential Multi-Asset Fund. So in this fund, what I found is, so this is the NAV value which I collected from the website. Based on the date, since January 20, I have taken the NAV value till December 22. Okay. So every day, these are the days I'm going to invest, and I'm going to simulate the example for you. So for example, say this is the date, 1st Jan of 2020, NAV value is 294, and I'm going to invest 1000 rupees. When you are in investment mode, so you have to mark it as a minus. So similarly, 3rd February minus 1000. Similarly, we are going to invest on 3rd February 1000 rupees, then 2nd March 1000 rupees. Once in a month, or every month we are going to invest 1000 rupees. So these are the number of quantities you would be able to buy, because NAV is like one quantity, price of one quantity. So with 1000 rupees you can buy 3.39 quantities. Likewise, during your SIP date, whatever the NAV rate, so you will get that many quantities. So at the end of the day, at the end of the investment period, so which is 1st December 22, NAV is 521, I was able to buy 1.91 quantities. So this is my current portfolio value. I'll just show you the summary over here. If you see here, so just ignore other things about whichever I'm highlighting, you just please, because we'll discuss others later. So number of quantities at the end of my investment would be 101 quantities. The invested amount is 36,000. During the withdrawal period, which is 2nd December, I would be having 52,687. So invested amount is 36,000 and I receive 52,000. And my XIRR is, so if you haven't seen, if you are not aware of XIRR, I have explained this XIRR in very detail. So please go ahead and check this video over here. I'll share the link here. Please don't miss that. If you want to do your finance by yourself, you should learn to do by yourself so that nobody can fool you. So this is very important, folks. Please, I made these videos especially for you to start from basics. So you should be able to understand how this calculation happens and how the returns are calculated. Please go back and check my playlist, which I have created for all these calculations like XIRR, CAGR, all those kind of things. So please watch this video, don't miss that out. Okay, come back to our video. So based on this, the XIRR is 27.81%. It's a very good return. We don't have any doubt at all based on the returns. But I'll just explain you a concept which is called inflation. As I explained before, that the petrol price used to be 16 rupees earlier and now it is 100 rupees. So which is due to mainly inflation. Your money value will be reduced. Your money values keep on reducing. So assuming that the money value which is getting reduced is 5%, which is called inflation rate, which is normally average is 5%. So if you do that from the month of when I start the investment till the end of the investment, assuming 5% as my inflation, your money value is reduced by 3,000 rupees. So even though you get 52,687 rupees, your final value would look like 49,534 based on the current scenario. So that is the inflation part. So now let's come to the step up concept. So in step up, what I'm doing is similarly I'm going to invest 1,000 rupees, but from next year onwards I'm going to increase my investment by 100 rupees, which is 1,200 rupees. And during the 2021 I'm investing 1,200 rupees, and 2022 I'm again increasing to 1,400. I'm increasing by another 200 rupees. So in such way, if I start investing or increase my SIP, the return I would get is, I would be buying 117 units. The invested amount is 43,000. The withdrawal is 61,000, and the XIRR is 27.43%. So in the other scenario, you would be getting 52,000. Now you are getting 61,000. So likewise, your money value will be managed. You won't lose the money value. So you since we are increasing our investment by 5% or 10%, that way we can beat the inflations. That is the main reason for step up. So every year you are trying to invest based on the inflation percentage. Your money value, since it decreases, so we are trying to add this inflation percentage to your investment. So this is how step up investment works. I just want to cover a story for you. In our Mindful Finance, we are talking about a super cool way to grow your money, just like the gods did in an ancient tale. Imagine this. Gods and the demons wanted something amazing, like super amazing. So they decided to team up and churn the ocean to get the nectar of immortality. But here's the thing. It wasn't so easy, and not at all. They used a big mountain as a mixer and a massive snake as a rope. It took lots of effort, patience and teamwork. As they churned, all sorts of stuff came out, stuff and not so good stuff, but they kept at it. And guess what? They finally got what they were looking for, the nectar of immortality. Now let's connect the dots. Think of this story as a step up SIP. You start with a small investment like a tiny churning, and then you keep adding a bit more every year. Just like the gods didn't give up when things got tough, with a step-up SIP, you don't stop when the markets go up and down. You stay the course, keep adding, and over time, your wealth grows. And that, my friends, is how you build a solid financial future. It's all about patience, steady progress, and knowing that nectar of financial security is within reach. So remember, just like the gods and the nectar quest, the step-up SIP, you are on a journey to financial success. It's about staying committed no matter what comes your way. Now, before we wrap up, that's one crucial piece of advice. Especially if you are new to the world of investing, consider consulting a financial advisor. Think of a financial advisor as your trusty guide, like a seasoned hiker leading you through a challenging trail. They can be a game changer in your investment journey. Here's how they can help. They'll sit down with you, understand your goals, and create a personalized investment plan. It's like having a recipe crafted just for you. So whether you are just starting out or seasoned investor, don't hesitate to reach out to a financial advisor. They can provide the expert guidance you need. Alright, so we have covered a lot today, from the type of mutual funds to the common pitfalls to watch out for. I also uncovered the magic of step up SIP and the importance of picking the right mutual fund for your financial goals. Remember, it's all about informed choices. Whether it's your investment objective, risk tolerance, or diversifications, you have got the tools to make smart decisions. If you find this video helpful, do me a favor, give it a thumbs up, share it with your friends, and hit that subscribe button. That way, you won't miss out on more informative content coming your way. If you have any questions or if there is a topic you would like me to cover in the future videos, please feel free to leave a comment below. I love hearing from you. Until next time, take care, stay mindful about your finances, and remember, your financial future is brighter than ever. See you in the next video. Thank you. Bye bye.